Welcome to the Deep Dive. We're here to break down what really matters in the markets.
And today we're diving into Fresenius Medical Care. We've got the details from their Q1 2025 earnings call.
Yeah, let's get right into the key numbers.
Okay, so headline figures. Fresenius Medical Care kicked off 2025 pretty strong. They reported organic revenue growth of 5%.
Solid start.
And operating income, if you exclude the special items and adjust for currency, that was up 11%.
11%, okay.
They also improved their financial footing. The net leverage ratio came down to 2.8 times. That's actually below the range they were targeting themselves.
Getting ahead of schedule on leverage then.
Seems like it. And importantly, they've confirmed their full year outlook, so they're still expecting revenue to grow, maybe positive to low single digits.
Right.
And operating income growth looking quite robust, somewhere in the high teens to high 20% range.
Okay, so the big picture looks positive. Let's dig a bit deeper. Where did that growth actually come from? How did the different parts of the business do?
Well, looking at the revenue side, it's a bit of a mixed story, but the underlying trends seem, pretty encouraging.
Okay.
Their main care delivery business in the U.S. saw stable same market treatment growth. Now, that's actually quite resilient considering they faced a really severe flu season.
Ah, right. I remember hearing about that. Did it have much impact?
It did. It caused an increase in missed treatments, knocking about 40 basis points off that growth number.
Okay.
But the positive sign is that the underlying referral trends seem to be improving. So for the full year in the U.S., they're still guiding for at least 0.5% treatment growth. They basically see Q1 as the low point because of that flu impact.
Got it.
Yeah.
And outside the U.S., how did international markets fare?
International was a real bright spot for care delivery. Treatment growth there accelerated quite strongly, hit 2.5%.
Well, yeah, that's a significant jump.
Yeah, suggests good momentum globally. Then you have their other big segment, Care Enablement. That had a really strong first quarter.
What drove that?
Solid volume growth and positive pricing momentum pretty much across the board, all regions. And what's really notable is the margin there improved significantly, jumped to 8.3%.
And that puts them in their target band, right?
Exactly, right in that 8 to 12% target range. So it looks like the strategy for that segment is really starting to deliver.
It wasn't all tailwinds, though, I gather. There were some divestitures impacting the numbers.
That's right. They're actively streamlining the business, selling off non-core parts, portfolio optimization, they call it.
Mm-hmm.
That did create a drag on the overall revenue growth, took off about 2.6 percentage points, and it hit the care delivery segment revenue even harder, about 3.7 percentage points off.
Okay, so that's masking some of the underlying growth.
Exactly. But they do expect that headwind from divestitures to lessen as we go through the year.
Okay. Profitability seems like a key theme here.
Mm-hmm.
We mentioned Care Enablement's strong margin, but what else helped the bottom line?
Well, besides Care Enablement's performance, their big transformation program, FME 25, that's all about efficiency and cost savings. It's definitely on track.
How much did they contribute?
In Q1 alone, 68 million euros in savings. They're aiming for 180 million for the full year, so a good start.
Where are those savings coming from mainly?
Primarily from Care Enablement, things like optimizing manufacturing and the supply chain, also from G&A functions, and a smaller contribution from care delivery, too.
And speaking of care delivery, how did its own profitability hold up, given the flu impacting costs?
It actually held up quite well. Operating income contribution was stable, and the margin even ticked up slightly to 9.3%.
What supported that?
Things like favorable rate changes, a better mix of services, and also a positive contribution from phosphate binders. Those helped offset the rising labor costs and general inflation.
Okay, interesting. Let's shift gears slightly. Talk about cash flow and the balance sheet. How's their financial health looking?
Right. So operating cash flow in Q1 was a bit lower than you might expect, but that was mostly down to seasonality in invoicing.
Okay.
But importantly, year over year, it was actually up 28%. That improvement came from better management of operating working capital.
And debt levels.
They continued to chip away at that. Both total debt and net debt, including leases, were reduced further.
Any recent financing activity?
Yes. Just after the quarter ended, they successfully placed 1.1 billion euros in new bonds. And they used some of those proceeds to buy back around 300 million euros of bonds that were maturing in 2026.
Proactive management there. Are they giving any hints about future capital allocation?
They're saving the details for their Capital Markets Day. That's coming up on June 17th in London. So we should get a much clearer picture then on their priorities dividends, buybacks, investments, that sort of thing.
Definitely one to watch. What about strategic initiatives? Any new products or technologies making headway?
Absolutely. The big one is high-volume hemodiafiltration, or HDF. The rollout seems to be progressing well.
That's the advanced dialysis therapy.
Exactly. They're expanding the pilot program in the U.S. and are aiming for an official U.S. launch towards the end of this year.
What's the big deal with HDF?
Well, two main things. First, the potential patient benefit. They've cited data suggesting it could improve patient mortality by potentially up to 23%.
Yeah, that's significant.
It really is. And second, there are operational advantages. It's apparently simpler to use, quicker to clean the machines afterwards, and might require less staff training.
So benefits on both sides. Anything else on the product front?
They're also actively prepping for the U.S. launch of their newer dialysis machine, the 508X. So yeah, quite a bit happening on the innovation side. Overall, they sound pretty confident about hitting their 2025 targets.
Okay. Now, these earnings calls always have a Q&A session. Did anything particularly interesting come out of the analyst questions?
Yeah, a few useful nuggets. They mentioned that April trading in the U.S., specifically the referral trends, looked encouraging. That backs up their confidence in the full-year guidance, despite that Q1 flu impact.
So the recovery from the flu season seems to be underway.
Looks like it. They expect to get a clearer picture on any lingering mortality effects from the flu when the May data comes in.
Okay, what else?
Phosphate binders. They confirmed a double-digit million euro positive impact in Q1, and they're still expecting that 50 to 100 million euro benefit for the full year. Apparently, the benefit was a bit front-loaded because of how average selling prices work before certain reimbursement bundles change.
Right. Any insights on pricing?
Yeah, U.S. revenue per treatment held up well. That was helped by the annual Medicare rate increase, the PPS update, plus some moderate commercial price increases. And globally, Care Enablement is seeing strong pricing momentum. That includes the full-year effect of that volume-based procurement system in China.
Got it. Did they talk more about the HDF strategy?
They touched on it, but basically said the detailed commercialization plan, how they'll pitch it, even to competitors, and quantify those operational benefits. That's all coming at the Capital Markets Day in June.
Makes sense. Any other efficiency efforts mentioned?
Yeah, continued focus there. Things like improving IT systems, revenue cycle management. Again, more on capital priorities in June. Oh, and someone asked about depreciation and amortization being lower.
Yeah.
Mostly due to the impact of divestitures they made last year. Selling off businesses reduces the D&A charge.
Okay. What about patient volumes and referrals overall?
Referrals are improving, but they're aiming higher. The goal is to get back to a 3% plus growth rate, really building that pipeline from earlier stage chronic kidney disease patients. New patient starts were actually down slightly year over year in Q1, but partly because Q1 had one less dialysis day compared to last year. The underlying month-over-month referral trend is positive, though.
Any worries about tariffs or the political environment?
They don't expect much impact from tariffs in 2025, mostly because they manufacture locally in the U.S. and have existing trade agreements. And interestingly, they did mention seeing a bit of a bump in referrals in Q2, so after the quarter ended, possibly due to a competitor having a cyber attack issue.
Well, okay.
On the regulatory front, they don't seem overly concerned about major changes from the new U.S. administration impacting their core dialysis business. One final point was currency.
Right, the exchange rate.
Yeah, if the euro stays strong against the dollar around the current 1.13 level, that could be a 2-3% headwind on both revenue and profit for the full year. Something to watch.
Okay, that's a lot of detail. Summing it all up then, what's the main message for investors from this call?
I think the main takeaway is positive momentum. Q1 showed strength, especially in Care Enablement and internationally. The confirmed guidance is reassuring, even with that U.S. flu headwind.
Right.
The big focus now shifts to that Capital Markets Day on June 17th. That's where you'll get the deeper dive into strategy, capital plans, and crucially, the rollout and potential impact of HDF.
So investors should really be looking for the outlook beyond just 2025.
Exactly. Understanding the path for further margin growth and Care Enablement and how quickly HDF can gain traction and contribute, those are the key questions going forward, I think.
All right, perfect. Now let's move to our favorite segment. This is not financial advice, where we brainstorm some, let's call them ambitious trade ideas. Based on this call, what's an outrageous but plausible scenario that springs to mind?
Okay, here's a thought. Given that confirmed strong operating income growth outlook, high teens to high 20%, and the potential catalysts at the Capital Markets Day, particularly around HDF and maybe capital returns, you could consider a long position in Fresenius Medical Care leading into that June 17th event.
Writing the anticipation.
Sort of. The idea is that positive surprises, maybe more concrete numbers on HDF's impact or clearer capital allocation plans, could give the stock a significant boost.
What's the outrageous part, or the main risk?
Well, the outrageous is betting on those positive surprises materializing and the market reacting strongly. The main risk, besides the obvious market volatility, is that currency headwind we mentioned. If the euro strengthens more, that 2-3% hit could dampen returns. And, of course, if the Capital Markets Day underwhelms, the trade goes the wrong way. So definitely hinges on positive news flow in June.
Got it. An interesting angle. Purely hypothetical, of course.
Absolutely. Not financial advice.
That wraps up our deep dive into the Fresenius Medical Care Q1 2025 earnings call. We've unpacked the results, looked at the key drivers and upcoming catalysts, and even explored a speculative idea.
Remember, this is just our analysis based on the call. We'd love to hear what you think. What stood out to you? Join the conversation in our community forum.
We'll be back soon with another deep dive. Thanks for tuning in.